Right now, there are two completely different stories being told about artificial intelligence. One says AI is about to reshape every industry, unlock massive productivity, and create the most valuable companies in history. The other says it's all hype, a giant money-burning machine held together by flashy demos, investor excitement, and promises that may never pay off. But here's the problem. Both stories focus on the same question: how powerful will AI become? And that might not be the question that decides who makes money, because a technology can transform the world and still destroy most of the companies that build it. We've seen this before. Railroads changed civilization. Airlines connected the planet. The internet transformed almost everything. But along the way, countless investors lost fortunes. Not because the technology failed, because too many companies spent too much money building the same future at the same time. And that's the uncomfortable possibility hiding underneath today's AI boom. The biggest risk isn't that AI stops working. It's that AI works but becomes too cheap, too competitive, and too expensive to provide. Think about what's happening. Every major technology company wants better models, faster chips, larger data centers, and more computing power. Nobody wants to fall behind, so everyone keeps spending. The logic sounds reasonable. If AI becomes as important as the internet, then companies need to build the infrastructure now. Waiting could mean losing the entire market. But when every company reaches that conclusion at once, something strange happens. The race to capture future profits can destroy those profits before they even arrive. To understand why, we need a simple framework. Let's call it the build-out trap. It happens in 4 stages. First comes the promise. A new technology appears, and the potential looks almost unlimited. Investors imagine enormous demand. Companies announce ambitious plans, and money begins moving toward the opportunity. Then comes the race. Competitors realize they could be left behind, so spending accelerates. Companies hire faster, borrow more, build more capacity, and lower prices to attract customers. After that comes the squeeze. The new capacity grows faster than customers can profitably use it. Competition pushes prices down while operating costs remain high. Revenue may keep growing, but the return on every dollar invested begins to shrink. And finally, there's the reset. Some companies cut spending, others fail. Assets get sold, the industry consolidates, and the survivors buy infrastructure for far less than it originally cost to build. Promise, race, squeeze, reset. That's the build-out trap. And once you recognize it, you start seeing it everywhere. Take the airline industry. Commercial aviation was one of the most important breakthroughs of the 20th century. It changed travel, trade, tourism, and business forever. The demand was absolutely real, but airlines had a problem. When one airline introduced a profitable route, competitors could add flights to the same destination. More seats entered the market, ticket prices fell, and the profit disappeared. The industry kept growing. More people flew every year. More airports were built. Air travel became essential to the global economy. And yet, many airlines struggled to produce reliable profits. Great technology, huge demand, difficult business. That distinction matters. A life-changing invention isn't automatically a great investment. Now look at solar energy. For years, solar panels were expensive, production was limited, and early manufacturers could charge high prices. Then investment flooded in. Factories expanded, manufacturing improved, competition increased. The supply of panels grew faster and faster. This was fantastic for customers. Solar power became cheaper and more accessible. More homes and businesses could afford it. But for many manufacturers, falling prices were brutal. Their product was improving while their profit margins were being crushed. Again, the technology succeeded. Consumers won. But not every company that helped build the industry survived. And that brings us back to AI. At the moment, the industry is obsessed with capability. Which model performs better? Which company has the most advanced chips? Who has the largest data center? Who can generate the best images, videos, code, or research? But from an investor's point of view, capability is only half the equation. The other half is cost. How much does it cost to train the model? How much does it cost every time someone uses it? How much must be spent on chips, power, cooling, engineers, marketing, and data centers? And most importantly, how much are customers actually willing to pay? That last question changes everything, because many users love AI when it's free. They'll generate images, summarize articles, ask questions, and experiment with new tools all day long. But free usage and profitable demand aren't the same thing. The real test begins when companies try to charge enough money to cover the enormous infrastructure behind the product. That's where competition becomes dangerous. Imagine that 5 companies offer AI assistants with similar abilities. One charges $30 a month, another charges $20. A third bundles its assistant into software the customer already uses. Then a giant platform offers something similar for free because it makes money somewhere else. What happens? Prices fall. Free trials get longer. Features get bundled together. Companies spend more on marketing, and customers constantly switch to whichever product gives them the most value for the lowest price. That's great for users, but it can be painful for the companies paying to run the systems. The better AI becomes, the more expensive the competition may become. Every major improvement forces everyone else to respond. A larger model triggers another larger model. A faster chip triggers another hardware upgrade. A new video generator creates pressure for competitors to release their own version. Nobody can stop spending because slowing down feels like surrender. But nobody can guarantee that the spending will create lasting pricing power. And that's the heart of the build-out trap. Companies aren't only competing for today's customers, they're competing for a future market that hasn't been fully defined yet. So, they build first and hope the profitable demand arrives later. Now, none of this means AI is fake. That's an important point. The internet wasn't fake. Air travel wasn't fake. Solar power wasn't fake. Railroads weren't fake. The bubble and the breakthrough can exist at the same time. In fact, the breakthrough often helps create the bubble. A completely useless product can only attract money for so long. But a technology with real potential? That can inspire decades of expectations to be pulled into a few years of spending. Investors see the future and assume the companies building it today will own it tomorrow. History says it's rarely that simple. The first builders often pay the highest prices. They buy equipment when demand is hot. They compete for scarce workers. They sign expensive contracts. They experiment, make mistakes, and spend billions teaching the market what the product can do. Then the next generation arrives. They use cheaper hardware. They hire workers trained by the earlier companies. They build on existing research. They buy abandoned assets at a discount, and they learn exactly which mistakes not to repeat. The pioneers create the map. The survivors use it. That's why the most important question may not be, will AI change the world? It probably will. The more useful question is, where will the value end up? Will it remain with the companies building the models? Will chip makers capture it? Will cloud platforms control the infrastructure? Will software companies use AI to protect their existing businesses? Or will customers receive most of the value through lower prices and better products? Those are very different outcomes. And there's another possibility. The biggest winners may be companies that don't look like AI companies at all. Imagine a logistics company that uses cheap AI to reduce delivery costs, or a small medical business that automates paperwork, or an insurance company that processes claims faster, or a manufacturer that uses AI to reduce waste. These businesses don't need to win the AI race. They just need the cost of AI to fall. That's what happened with the internet. Many of the companies building early internet infrastructure disappeared, but the cheap infrastructure they left behind helped create streaming, cloud software, online shopping, social media, and countless businesses that came later. The builders took the risk. The next generation inherited the foundation, and we may be watching the same process begin again. More chips, more data centers, more models, more competition, more money chasing the same uncertain pool of future profits. Eventually, the market will demand answers. Not just impressive demonstrations, not just user growth, not just announcements about what might be possible 5 years from now. It will ask how much money each company earns after paying the real cost of providing the service. That's when the difference between technological progress and investment returns becomes impossible to ignore. AI doesn't need to fail for investors to lose money. It only needs to become more competitive than expected. It only needs prices to fall faster than costs. It only needs companies to build more capacity than the market can profitably absorb. And if that happens, the strange result may be that AI becomes incredibly successful while many of today's AI businesses don't. So don't just watch how many people are using AI. Watch what they're paying. Watch how quickly prices are falling. Watch how much companies must spend to keep up. Watch whether customers stay loyal or jump between similar products. And watch who owns the infrastructure when the excitement finally cools down. Because the real story isn't simply whether AI is a bubble or a breakthrough. It could be both. The real story is who pays to build the future, who survives the race, and who shows up afterward to buy that future at a discount. If you want more videos that look beyond the headlines and explain the financial forces moving underneath them, subscribe, because the loudest story in the market usually gets the most attention. But the quiet numbers? Those are the ones that tell you who's actually making money.